16th edition when we're recording this of Freightonomics. Zach Strickland, head of market intelligence, Tony Mulvey, senior analyst, here to give y'all an update on everything global supply chain related, as well as this domestic freight market and general economics as well.
Yeah. I mean, we'll have, next time we meet or have this, we'll have a new president. TikTok might be banned.
I know.
A lot can change in the course of the next week.
The world is a dynamic place. And we were going to have Dr. Rogers on this week, but he got called away. Hopefully next week we'll have Dr. Zach Rogers. But today we've got plenty of stories and topics to discuss, as well as giving y'all an update on the current state of the freight market.
Yeah, that's the best place to start, Zach, because I think it sets the stage for the rest of the show. So we'll get a market in 2 if you're ready. We'll count you in.
See if the back end's ready.
3, 2, 1.
All right. Tender rejection index. Focus on that white line there at the far left of your screen, right next to me. It is inching higher. Now, this is an unusual, I say unusual, but it is unusual this time of year to see rejection rates climb in the middle of January. Martin Luther King Jr. holiday coming up, not necessarily as impactful of a holiday, certainly doesn't remove capacity from the market like Christmas, Thanksgiving, and some of the other major holidays, but this is winter weather. It has winter weather written all over it. The last couple of weeks, or actually the last week, we've had a couple of systems come through, really disrupt some transportation networks. It has not necessarily been groundbreaking disruptions, but 8% rejection rates in January, especially considering where we've been the last 2 years, are nothing to sneeze at. And they are markedly higher than where they've been the previous 2 years. You see 2024 there in the teal bluish color and then the fuchsia color 2023. So definitely directionally moving the way that some of the transportation providers would like for it to. Let's go to the next chart. Speaking of moving a direction, this is RTI, Refrigerated Truckload Index here. Spot rates for refrigerated loads spiking right now. A lot of this is derivative of a lot of the weather events, also colder temps, protect from freeze season, helping to really push this higher. The Southeast, the Atlanta market has seen some of the more significant increases in refrigerated rates. Nashville, et cetera, had some of that snow come in a little bit, but also the dry van market is also up as well, but that refrigerated sector will benefit from cold temps. Let's go to the next chart. None of this is happening because of demand. OTVI there in the white is declining. It is not outperforming last year. We were much higher in demand last year until we get to Martin Luther King holiday. Tender rejection rates there in the bluish color are going up. And let's go last but not least to the last chart. The reason that demand isn't having an impact as much is because capacity is leaving the market, and that is why that chart is in red.
That chart, to me, signals exactly what we're seeing in the rejection index to some degree.
Let's leave that one up for a minute because I didn't do it justice. It is the net change in FMCSA operating authorities for motor carriers.
Mm-hmm. Yeah, so effectively it's is an authority active or not, and what's the difference in the growth versus the exits. And it's been negative, basically averaged about down, call it 200 carriers a week for over 2 years. I think that's the sign that it's like we're getting to the stage where enough capacity is leaving the market or has left the market.
And continues to leave the market.
Yeah, it's not slowing down.
Most people don't see an 8% rejection rate in their business and say, okay, things are getting better for me. I'm now going to stay online. No, they've been losing money for 2 years, effectively, and they've burned through it. So
they're long-term decisions that are being made based on what's happened, not where the current environment is. I think one of the interesting things is when you really start to look at, you wouldn't normally, you see volumes down slightly to start the year, which is expected, but then you'd probably see rejection rates tend to follow that because everybody's coming back online. They're wanting to keep their equipment filled, utilization high. And you've gotten, I think one of the big impacts is you look at rejection rates across the country. I mean, they're up broadly speaking outside of Southern California, which is interesting, but I think some of that is a factor of carriers wanting to get equipment out of Southern California versus anything else. But you talked about winter weather. You look at Dallas. I mean, Dallas is a prime example. Expectations last week for Dallas weather when we were here talking.
Well, I got a weather map this week because this weather map, of course, is actually for the forecasted temperatures next Monday. in critical events in sonar. So anything there in that kind of reddish tinge is very cold. It's in the teens and below. So anything below that, of course, and you're seeing this edge of this nose of cold get all the way down into Texas, areas that it's not used to being 20 degrees as a high.
Yeah.
And this is an important thing to watch and monitor next week for those of you listening or watching this show to start your week on a Monday, as some tend to do. This is going to be an important week. We had almost the exact same thing happen last year, where we had this nosedive in temperatures through the Midwestern corridor. Operations cease when it gets too cold.
Yeah.
We had negative wind chills. I mean, there's some freight that just can't move in that temperature. Trucks stop operating.
Yeah.
You get fuel gelling and diesel engines freeze up. It is not a good operating environment for both trucks and some shipping operations.
Yeah. And I think looking just at the last weekend, right? I mean, you look at the impacts that potential winter weather has and what's to come with that. Shout out to Kaylee Nix. I mean, she was pretty dead on with her forecast here in Chattanooga, but you start looking, it's hard to forecast what weather patterns are going to do and what comes of it. But I think what's interesting is if you think about it, just the thought of severe winter weather, I don't want to say spooks carriers, but it does to some degree. If you were to look at Dallas inbound rejection rates, which is one thing we don't talk about a whole lot because they're really not, typically they're fairly low. And it just kind of gives you a gauge of, does a carrier want to go into a market? Well, Dallas last week, they spiked Thursday, Friday, Saturday. Tells you carriers were going to avoid that market. Well, guess what that means this week? Operational challenges for those shipping freight out of the market because the carriers or drivers that would normally be in the market weren't there, and it leaves the market starved for capacity. And you see rejections move up in some of these markets.
Yeah, and we don't have and the point is that we don't have the capacity available that we had in the previous years where there's trucks literally starving for freight everywhere, sitting on the sides of the streets. We can see that reflected in the elevated tender rejection and spot rates. The fact is that these network disruptions are becoming more noticeable in the market in general. So next week, and I know that we're not going to speculate on any weather, even though it looks like Texas is going to be yet again
it's going to be cold.
It's going to be cold.
For
sure. The snow and ice potential is there, but again, by the time some of y'all are listening to this, that will have changed dramatically. So I'm not going to get in it ahead of myself. Just monitor the weather this week, especially anybody across that central northern corridor and into Texas. And of course, portions of the Southeast that aren't used to this type of weather.
Absolutely. But I think this gives us kind of good leeway into what's going on in the news with FreightWaves.com. I think one of our first stories is interesting. We've gotten a lot of news, a lot of maritime, a lot of global news, a lot of macroeconomics that we'll touch on. That Michael Rudolph did a great story on FreightWaves.com. But I think the first one's the interesting one because you've gotten ceasefire in Gaza.
Right.
So kind of easing of the tensions around the Red Sea. And I think overall, when you start looking at it, you're going to see more transits through the Red Sea as a result.
Yeah, Stuart Charles writes this article, When Will Ocean Carriers Return to the Red Sea? And he lines out a pretty decent little timeline that essentially leads you to sometime after mid to late February is where they really expect to see capacity operation kind of adjust, because this is not something that's going to happen overnight. Certainly nobody really trusts any kind of confrontation resolution between Middle Eastern groups. I mean, Israel and Hamas, Israel has effectively won based on the fact that the Hamas and Hezbollah leaders are both now dead. Then Iran has been severely impacted infrastructurally. He lines all of that out in the article, and it's basically to the point where it's like you can't really keep aggressing to the point. But this has happened before. So while this is getting ironed out, there's 3 phases to this ceasefire. A lot of these carriers aren't just going to say, okay, everything's all better and start moving their operation around it. It's going to take time, certainly not completely removed. And in the meantime, though, we have seen some responses. Spot rates have dropped.
Yeah, I think what's interesting is like the Lunar New Year impacts, because if you think second half of February, it's kind of post Lunar New Year impact with it's starting on January 29th, and call it 2 weeks. So I mean, you're kind of right there coming out of those impacts. So instead of the longer transit times that tend to pull capacity out of the global shipping market, with going back through that, it kind of offsets during that shutdown. If you have a boost in demand on the back end, well, now that capacity is moving, the transit times accelerate, specifically for Europe. I think that's probably where it's more impactful.
Yeah,
but the capacity is fungible across the globe, right? Mm-hmm. One of those container ships that was going to the U.S. now may go through can go to Europe, right, and vice versa. Things that were going along, they can come to the U.S. It's no different. Like, it's not a different ship or vessel that's going. Like, they can move them about. It just makes it a little easier for the ocean container lines.
Yeah, it's far less fragmented space on the ocean carrier level, and of course, what affects one affects all of them.
Yep.
And I think this is going to be obviously deflationary from a storyline potentially here on rates. And I think service should iron out, although it's hard to say that you're completely out of the woods at any point when you're talking about the Middle East and their confrontation. But who's really going to like this is Egypt.
Yes.
Tolls from the Suez Canal dropped 60% in 2024. So this has a pretty strong economic impact for that area. Legitimately, volumes declined by 75% from 2023, according to Project 44. So this is going to be an economic boost. So this was never really a sustainable situation for that region anyway. The next thing that got resolved, more in the homeland front here, it was the port strike. Now no longer a thing. That got ironed out. We talked about it a little bit last week, but it is important to note that this is something that we can get back to normal in terms of domestic import behavior. If we pull up the Freightos Baltic Exchange data set here, I think this is related to the FBXD, that's the IOTI. But import demand, while we've got it, well, we'll talk about that here in a minute, but the FBXD, of course, spot rates for containers moving from China to North America's east and west coasts. The East Coast is going to be the white line. The West Coast is going to be the yellow line. You can see we got a GRI earlier in the year on the heels of Lunar New Year expectations, the continued issues with the Red Sea. Now that that's resolving a little bit and we don't have the ILA strike looming, rates have pulled back a little bit. They're still well above where they were, though, before all the Red Sea stuff started.
They are. I think it's interesting. I think, to me, it signals that the pricing power for the ocean carriers is fading. Like, you talked about them not being as fragmented. They have the ability to push rates up very quickly, and you can see that in this chart. Just that it would be more telling if you had this chart, over the course of 5 years, to see the ebbs and flows of how quickly they're able to effectively move the market. But I think what's interesting is when you look at it, you see the downward move recently, but
it's pretty sharp.
It's sharp. It tells me capacity availability is not an issue. Yeah. Like, it's readily available. Demand may not be as strong as expectations, and you're not worried about the outside influences that were impacting the market. So it's like everything from an ocean carrier shipping line, everything that could go wrong for your business is going wrong, right? Demand's not as strong. Capacity is going to be more readily available because you have shorter transit times. You've got, you have no risk of port strikes and things like that. You're adding capacity to the market, right? What is it? Expectations for 8% additional capacity. Everything right now.
Also, everything that you did last year, this is a sort of a mini economic bubble for these guys that obviously had another round of record earnings for many of them. But it's been incentivizing this early pull forward or bringing inventory in front of things that has been happening. So without kind of the reason to, fear any destabilization, they're ready. Like, shippers and importers are ready. And this is where that IOTI chart really becomes relevant, because something I think a lot of the carriers were counting on was growth in demand in front of Lunar New Year and the pull forward activity. If you look at this chart and you see the white line there is nearly in perfect alignment with the previous year's line, and it's following a very seasonal, traditional pattern. There is nothing new here. This is literally something that we've seen before. Is it elevated over a few of the years, like the pre-COVID years? Yes, but it's not breaking any thresholds. Infrastructure's in place. Looks like this is business as usual for many shippers.
Well, and I think it's funny. We've got 15, 20 minutes in the show and haven't mentioned tariffs at all.
Yeah.
Right? Like you've seen, if you look at that teal line, it's hard to see it in perfectly here because we have the COVID numbers in there.
Yeah.
But you can see how long it was. Almost like this peak season last year on the ocean side was so long and elevated from the previous year. It's like, well, yeah, we don't need anything else here in the U.S., especially if you look. I mean, even if you go into November, December, like there was a decline with the Golden Week holiday. But our recovery out of that, I mean, we came back out at elevated levels.
Yeah, you can sort of see this at the very right
end.
Yeah, the very right. You can see where we normally have a dip in November, leading into December a little bit, where volumes kind of drop off. Shippers stayed active and in a stable fashion. There's no big spikes down this year. So it looks like a lot of that is probably muted. Some of the potential.
We talked about the risk management element of it. But I mean, you had to think about it in November, December, when they were booking the vessels or the space on the vessels. You have to think, you had the risk of a strike, you had unknowns around tariffs, you still had the Red Sea, you didn't know what demand was going to do. So you were doing all these things to get in front of it, and now all of that stuff is unwinding. So it's like there's no like good reason to be like, oh, we're going to see some massive demand boost outside of, you're going to see some with Lunar New Year. That happens every year.
It'll spike up, but it's not going to.
It's just a matter of do we follow what we did last year? I mean, National Retail Federation expecting a 10% increase in January compared to a year ago. I find that hard to believe, and I find that hard to believe because we've been up that much year over year for the past couple. I mean, really, most of 2024 was up kind of double digits. It was hard to see that continued growth at that level carrying on when, some of those risks are unwinding.
Yeah, I think the positive takeaway there, if you're listening, is that economically, we're going to continue.
Yeah.
We're going to continue to have strong demand from the retail consumer side, based on their expectations. Of course, nothing's given until it happens. But I think the one component of all this is the economic component. That there's a lot of uncertainty still sitting out there. We've got inauguration next Monday. There's so many questions about the next Trump presidency and what it means economically. I think it's hard to imagine that he will stand for any kind of downturn in the economy. But he doesn't necessarily control every single lever all the time. And sometimes he's been known to kind of overstimulate those levers. But that's neither here nor there at this point. But in the meantime, a lot of these companies, as they're preparing, aren't really making a lot of commitments.
Yeah.
And I think that's going to be a little headwind on demand to start the year.
Well, I think that's what we've heard from customers, right? Is like there's so much like we really don't know what to expect. Yeah. Like we're forecasting basically flat because we don't know. We could see an uptick, but we also could not. So it's really hard to do that. And then you start getting some of this economic data that suggests, well, you're not going to get stimulus from Fed rate cuts.
Well, let's talk about that because Michael Rudolph wrote an article, which is in our next piece here, the December inflation data. So I'm going to let you run with this one.
Yeah, so CPI came in at 2.9%, core inflation at up 0.2%, coming in at 3.2%. So think core inflation, excluding fuel, excluding food, things that are more volatile in nature, both above long-term targets.
But 2.9 is not...
It's not bad.
Not bad. Like typical targets are between 2 and 3%, correct?
Correct. I think the long-term target, the Fed's targeting is 2%. I think what's interesting, though, is you had a 0.4% increase. So you're up 2.9% year over year, basically the last 12 months. But a 0.4% increase, if you annualize that over 12 months, you got that it's 4.8%, which is an acceleration.
Right.
So what the Fed is not going to do is cut rates when inflation is accelerating. So when you have a meeting in 2 weeks, you're not going to get a rate cut then. And then you add in that the labor market is quite strong. So the Fed has two goals, right?
Right.
Inflation near or trending to the long-term target of 2% and maximum employment, right? Or limiting unemployment.
But we tend to see some level, and I guess this is December data that we're talking about.
We are.
Which is a little alarming, especially from the transportation sector.
Mm-hmm.
I don't know. I mean, people that look at some of the labor data probably will have reason to say that can't be right. But it is what it is at this point in time. How much you put stock in this labor data, it hasn't really changed the way it's moved lately.
It's been strong. I guess my thing is it's been strong. I mean, you look at unemployment rate at 4.1%, historically low. If you look, it isn't. So it's interesting. If you were to look at it over call it the last 2 years, it looks elevated. But if you looked at it over call it the 15 years prior to the pandemic, it's extremely low. I mean, it's like 2 percentage points lower than what the historic average
Economically speaking, we're doing just fine from a historical perspective. It may not feel like COVID.
I think what's interesting is like everything suggests, though, that the consumer should be slowing down, right? You've got inflation accelerating to a degree. You had wages that really didn't keep up with the rate of inflation for quite some time. That kind of reversed course in parts of last year. But I mean, and you've got savings rates that are low, credit at all-time highs, outstanding revolving credit, interest rates that are still elevated. Everything suggests that a consumer would be slowing down, like hitting the brakes. They're not doing that, which is a good thing for the freight market because they are still spending. As long as they continue to spend money, freight will move.
And if we have a cold winter, guys, like I will switch my stance in March. If we have if it stays cold throughout February, and then it warms up in March, as it typically does.
Watch out.
Like I feel like we've got the potential, especially the fact that we're seeing more of a supply side issue, contraction than the demand side. So it's again, I take the labor numbers still with kind of a grain of salt. I don't think that they're the same as like you can't look at them the same way that you did before the pandemic.
Well,
but they're not giving me any signs that I'm like, they're grotesquely off.
I think the challenge when you look at the labor numbers is where's the growth happening? It continue. We've talked about it. I can't tell you how many times on this. Leisure and hospitality, so bar and restaurant hiring, government and healthcare. Like those are the three drivers of added jobs in the economy. I think one of the interesting ones in the December data makes sense was retail. We'll see how that plays out.
It's holiday, seasonal.
Well, and they've been running fairly lean. So you have to boost it. So
I was shocked by the transportation. I was. I don't know that. Although I do feel like we have hit the bottom in the transportation cycle. By a few months for sure. But it is. I was shocked to see the growth there.
Yeah, I am. Because especially when you start listening to, some of these executives talking, you hear, I mean, I've heard it in the oil and gas space. They're not wanting to go and hire rapidly. I mean, they don't know what's coming from an interest rate environment, which helps stimulate some of their activity. But the general theme is doing more with less. And I think that's a trend you'll see continue.
Although it's probably the smart play if you're gaming the market turning. Like this is the time to hire up the talent now.
Because then you have them trained and ready for when the market does transition.
6 months to get, your mid to upper level performers and ready to go. They don't just come in overnight. And so if you're trying to get ready for a decent market flip, now is absolutely the right time to go out and grab that talent before everyone else does.
It's hard to do that in reality.
Well, the CFOs don't like doing it.
They don't, because it's adding an expense where you're not boosting, top line.
But I think this is where transportation CFOs have a little bit of an advantage in the way that they're kind of trained to know that January, February are not stellar months.
We talked about it before. It's like you want to limit the hole you start the year with and then grow.
We were talking to Todd Davis about this morning, about how you just want to start off the year in less of a hole because you're going to start off slow. Although this year's been a little different. I mean, looking at the spot and rejection rates, any type of disruptive event, 8% rejection rates in January.
Well, that's what I'm saying. That's my thought is we're at 8%. If you get a severe shock to the market in any way, right? Whether it comes from a spike in demand, a weather event, something like that. the market is far more fragile than when we were at 4% this time last year,
Yep.
right?
And rates are going up. Contract rates are showing some small increases right now. So there is reason to be bullish in transportation for this year.
Quick question, because we have a very short time. Do you think that's a protection from shippers to secure capacity, raising?
Yeah, I think it's absolutely that, as well as
the market
itself. Like, service has gone down. We see it in the data. So why not? It's a smart move.
It's something. It's a more active January. The conversations we're having are positive.
To start off the year like this is all gravy for a trend.